They tell you the economy is strong. They point to the stock market, hitting all-time highs. They say unemployment is low. They show you charts of GDP growth and tell you that the crisis was averted. But beneath the surface, something is breaking. If you look away from the headlines and look at the bank accounts of average Americans, you see a different story. The American consumer is not strong. The American consumer is drowning. For the first time in history, American credit card debt has smashed through the $1.13 trillion mark. That is a number so large, it is hard to comprehend. But let me put it in perspective. That is more than the entire GDP of most countries. It is more debt than we had right before the 2008 financial crash. Savings are gone. The stimulus checks have long been spent. Inflation has eaten the safety nets. And now, to keep the lights on, to put food on the table, millions of families are turning to plastic. We are living on borrowed time. And the clock is ticking. To understand why this bubble exists and why it is about to burst, you have to understand how the banks view you. This is not a relationship based on trust. It is a game. And in this game, you are the prey. In the banking industry, there are two types of people. First, there are the transactors. These are the people who use their credit cards like cash. They pay off their full balance every single month. They get the points. They get the airline miles. They get the cash back. And they pay zero interest. Banks hate these people. In the internal memos of the credit card industry, they are literally called deadbeats. They're unprofitable. They're smarter than the system. Then there are the revolvers. This is who the entire system is designed to trap. A revolver is someone who carries a balance, someone who pays just enough to keep the account open, usually the minimum payment, but never enough to escape the debt. This is the bank's favorite customer. This is their goldmine. Why? Because in 2025, the average interest rate on a credit card is over 22%. That is a record high. On store credit cards, it is nearly 30%. Think about that math. If you owe $5,000 and you only make the minimum payment, it will take you over 20 years to pay it off, and you will pay double or triple the original amount. In interest alone, this is not lending. This is predation. It is a mathematical trap designed to keep you in chains forever. Once you become a revolver, the interest grows faster than you can pay. You're not buying groceries anymore. You're financing your own poverty. And right now, the banks are creating revolvers at an industrial scale. But the 1.13 trillion figure? That is only the visible tip of the iceberg. That is just what the Federal Reserve knows about. There is a shadow debt, growing in the dark, completely unregulated and unmonitored. It's called buy now, pay later. It started innocently enough. It started with luxury items, Pelotons, and MacBooks. But look at where we are now. Go to a checkout counter. You will see people financing their sneakers, financing their pizza, even financing their gas. Companies like Affirm, Klarna, and Afterpay have gamified debt. They have made borrowing money feel like a sleek, fun, Silicon Valley experience. But beneath the colorful app interface, it is the same old debt trap. These services create phantom debt. Loans that often don't appear on your credit report immediately. This means a lender cannot see how much debt you really have. You could be drowning in buy now, pay later loans and still get approved for a mortgage you cannot afford. Millions of Americans, especially Gen Z and millennials, are technically insolvent, but the data doesn't show it yet. It is subprime 2.0, and nobody is watching the risk. But who benefits from this? While the banks trap you with interest. Two giants control the cage, two companies that act as the gatekeepers of the global economy, Visa and Mastercard, the duopoly. Together, they control over 80% of all card transactions in the United States. They don't lend money. They don't take risks. They simply own the rails that money moves on. And they act like a private tax collector on every single purchase you make. Every time you swipe your card, every time you tap your phone, they take a cut. It's called the interchange fee. It is a fee hidden from you, but paid by the merchant. Merchants hate it. Small businesses are crushed by it. So what do? They pass the cost to you in the form of higher prices. That helps drive inflation. And when inflation goes up, everything costs more. So what do? You use your credit card more. It is a perfect, vicious cycle designed to funnel wealth from the working class straight to the top. In 2024 alone, merchants paid over $100 billion in these swipe fees. That is $100 billion extracted directly from your community, your local shops, and your wallet, just for the privilege of moving digital numbers from column A to column B. So, when does the music stop? The terrifying truth is, look at the data. It is already stopping. For years, the delinquency rate, the percentage of people missing their payments, was historically low. But starting in late 2024, that line began to spike vertically. It is spiking faster now than it did before the Great Recession of 2008. The revolvers are running out of ammo. Credit limits are being maxed out. Savings accounts are empty. And when the spending stops, the corporate profits crash. And when profits crash, the layoffs begin. It creates a domino effect that cannot be stopped. It starts with a missed credit card payment. Your credit score takes a hit. Because your score drops, Your car insurance premiums double. Suddenly, you can't afford your car payment. The repo man comes in the middle of the night. Without a car, you can't get to work. You lose your income. You lose the house. We are currently seeing auto loan defaults hit levels not seen in 15 years. The American consumer is tapped out. They have nothing left to give. The Federal Reserve raised rates to fight inflation. They claimed they wanted a soft landing, but they trapped the consumer in a cage of high interest. If they keep rates high, the interest on this massive debt becomes unpayable. Defaults will sweep the banking sector, causing a liquidity crisis. If they cut rates too quickly, inflation returns with a vengeance, and the cost of living forces people to borrow even more just to survive. They are trapped. And you? You are the collateral damage. Why do you think major banks like Capital One and Discover are trying to merge? Why are they closing branches? They are bracing for impact. They are stockpiling billions in cash to cover bad loans. They know what is coming. They are preparing for the burst. So, the question remains, what do you do when the system is rigged against you? What do you do when the math guarantees your failure? You stop playing their game. The credit card debt bubble will burst. It is a mathematical certainty. When it does, credit will dry up instantly. Limits will be slashed. Loans will be recalled. Those who are dependent on debt will be wiped out. The banks are betting against you. They are betting you will stay a revolver forever. They are betting you will pay them interest until the day you die. Prove them wrong. Pay the balance. Attack your debt with everything you have. Build your cash reserves. And step out of the system where you can. In a debt crisis, cash is the only freedom you have left. It is the only asset that has no counterparty risk. Don't let them win. We watch the money, so you don't lose yours. Subscribe to The Ledger